Sandeep, what is your take on on the Fed policy outcome, and how do you see markets behaving?
The Fed policy was more or less on expected lines, in the sense that there was an expectation there'll be a 25 basis point hike, so that happened, and there were some people who were expecting that because of Ukraine, Russia, some new COVID waves in some countries, Fed might actually make some comments that there is still uncertainty. So they just disregarded those comments, and then they said that it's a very strong economy with strong unemployment. Wage inflation is high, although it's not spiraling out of control, but it's still very high. And they will undertake rate hikes and also a reduction on the balance sheet from May. Now, I think it's important for many people to actually understand that when a theory is being floated around in general, that like people have done a lot of analysis of past Fed rate hike cycles and at what stage of the cycle the bull market actually ends and all those things. So, this is not a normal scenario. So my view is that you cannot correlate what happened in the past to now, because one, in the past we did not have this kind of balance sheet expansion of the global central banks ever. Secondly, we did not see inflation go up so high for the last 40 years. And to that extent, when rate hikes and balance sheet reduction starts happening simultaneously, let's say 80 to 100 billions per month, if they start reducing, then it will have a significant impact, in my view, on the valuations of risky assets. Now, risky assets include equities, real estate, cryptocurrencies, NFTs, metaverse, linked assets, commodity prices, etc. So I think there'll be an impact across the board, and that is something we need to monitor. Now, prolonged period of zero interest rates has led to excessive risk taking in assets with no underlying sort of, I will say, fundamentals. And to that extent, I think those are the asset classes which will get most impacted. Equities in general have gone through various cycles. They have seen monetary price cycle ups and downs, etc. And to that extent, we'll see a valuation contraction for sure. But whether it will lead to an end of the bull market, that looks unlikely at this stage, simply because of the fact that there's been so much of disruption due to COVID, that in any case, economic bounce back will continue to be there. And the inflation trajectory is important to monitor, because historically it is high inflation which actually typically kills the bull markets rather than anything else.
Sandeep, just wanted to sort of follow up on that. When you say high inflation kills the bull market, is it high? Is the inflation itself, or isn't it the rising interest rates as a reaction to inflation which kills the bull market?
Yeah, so it's always monetary policy reaction. So when inflation is very high, then typically monetary policy will need to be tightened so that inflation comes back down, because it's pure economic theory that too much money is leading to less
Which
number
means
of
that
goods.
we can't. Which is going to happen, right? I mean, I agree with you that this is not the same scenario as the global financial crisis or the oil shock or any other recession that we have seen in the last couple of decades or even slightly longer. But the reaction is going to be the same, which is higher interest rates, and obviously, six more times after this one. Isn't so? Do you still believe it isn't enough to sort of rattle the bulls, or do you think what is different from those interest rate hikes and this one?
What is different is the pace of the hike cycle, and secondly, the balance sheet reduction, because the balance sheet has doubled over the last since the start of the COVID wave, or almost doubled. and that has been one of the biggest contributors of money flow into a lot of risk assets. So as those balance sheets start to contract, the impact will be felt across the board. And as bond yields move up, so all of us know valuation models are there. When risk free rate moves up, then how the valuations of other all the other risky assets as it is gets adjusted. So all those things are going to happen. Now it's going to be very it's going to be a complex interplay across the board, because till 10 years back, when we used to evaluate asset classes, more or less we used to have three: equities, bonds, and real estate. Now there is a whole another universe of assets, cryptocurrencies, NFTs, and like there's so many of them, the kind of SPACs which have come up. And so it's become more and more of a complex world. So I think those interplays will need to be seen, but the valuation contraction will be for sure. So real earnings will stand out. So companies with real earnings, real cash flows will stand out as against companies where there is no earnings or low visibility of earnings, or they are burning huge amount of cash continuously. Those companies will suffer more.
Hi, Sandeep. So there was another announcement earlier today about China announcing a stimulus for the economy. Obviously, they are also going through another bout of COVID cases, and there have been harsh lockdowns in some of the largest cities again. So, do you think that probably we would see Chinese stocks or China coming back, and with that, uh, probably the markets could also stay afloat? Or could it be that the last 7-8 days is just a relief rally, and basically your take on how do you see the markets for the rest of the year?
See, the Chinese economy is in deep trouble, and their consumer confidence has been going down. Look at all parameters: real estate sales, automobile sales, etc. They have been in trouble. Their excessive fixed asset investments into assets and building uh, infrastructure which is not yielding, or and real estate which is not yielding any returns, is has led to a huge trouble of so we all of us there was a big bankruptcy of a large real estate group in China a couple of months back. So I
Yeah,
think
Everman.
all of us will remember what happened in India when the real estate cycle busted and so many companies went down, and we had a 10-year period. So the kind of NPAs banks, NBFCs got, etc. So it took us 10 years almost to come out of it. And I don't see, I think China is in even a bigger trouble because of the fact that in India, at least, it's more of private investments or private companies taking risk. But in China, it's more of state driven investment, local bodies, all those things are happening. And they have also kept the interest rates too low for their savers for too long. And as such, too much money gets directed towards highly risky asset classes, structured products, etc. So I think all this stimulus and all is going to do nothing much for China. I think Chinese economy will keep on slowing at a very rapid pace for the next 5 to 10 years, in my view. I think eventually Chinese growth is going to maybe 2-3% over the next 4-5 years, and any amount of stimulus is not going to impact that. Now that has global repercussions, which are positive as well as negatives. So negatives obviously are that global growth suffers. Some positives are that China is the biggest consumer of most commodities, and since China is the biggest consumer of most commodities today, as that growth slows down, we could have relief in terms of commodity prices for the rest of the world, which could eventually take in the inflationary trajectory down. But I think that's some way off.
Sandeep, there's a WhatsApp forward going around about the mother of all rebalances happening, and yesterday, after a very long time, we even had a positive figure for the FII flows. Uh, do you believe that we could see this trend reversing, or do you believe that the FIIs will continue to be net sellers? It's almost been like 6 straight months that we've seen outflows from FIIs, and it's been what the record
See, I
high.
think
And
relying on taking decisions based on funds flow is the worst thing you can do. So, for someone who lived through the 2008 crash, 2007 was the best year of flows into emerging markets and also India till that time. And then 2008 was the worst year. So, we should not look at flows at all, in my view. I think the only things which matter are fundamentals, valuations, and the macro factors, and that's what we need to evaluate. All these things will come and go. So, because of some externality, which also I don't know is going to happen or not, some rebalancing happens. So, because of that, some people are forced to buy some particular asset class for a short period of time. It really doesn't impact you. So I think if some move is happening just because of such technical factors, then it makes sense for you to actually use that as and exit and rebalance on the other side, I would say. So I think that's what I'll say on this thing.
Yeah, I mean, I think this is a general consensus. I think the analogy was great, Sandeep, right? I mean, if you are looking at flows and making a decision, one good year could always be followed by a horrible year, and that's happened in the past. I think one question that I have in my mind is, again, going back to the Fed conversation. I think we have a few loose ends there. So what have we agreed upon, right? What we've agreed upon the fact that like most commentators around the world, inflation is going to remain high, and it's probably going to be worse as far as US is concerned because of, like you said, a complex interplay of commodity prices, geopolitics, what's happening in China and everything else, right? So it's more likely to be a higher, more inflationary world than it is today, and therefore the reaction, the second point that we agreed upon is that most bull markets have been rattled by, at least the data that is being projected to us today as a reaction to the Fed statement, is that every time high inflation is corrected with an aggressive monetary policy, it leads to the end of a bull market and an economic recession. And that's Larry Summers' research paper that I'm referring to. But that's just one side of the argument. The other side of the argument, which we haven't touched upon so far, which is to say that at the end of the day, you can call it hawkish, dovish, whatever word you like. End of 2022, the projected rate is still 2% in the face of an 8% inflation. I suspect that your line on reduction of the balance sheet captures it, but I would like to hear a simpler version of the same answer if you like. Is 2% interest rate, a benchmark interest rate with in an 8% inflation era? What does that say about the world that we live in, and what impact it will have again on emerging markets like India?
So what that essentially says is that it just promotes excessive risk taking, because all the savers are making a negative return if they are saving on let's say in a bank FD. So in the bank FD in the US, UK, etc., you really get nothing almost. And to that extent, it has promoted asset allocations which historically would not happen, and people are heavily misallocated towards highly risky assets at this point of time, and that will get rebalanced. So when we talk of this whatever this WhatsApp forward kind of rebalancing, I think that's more tactical, which which I think makes no sense for people to just pay attention, except for some traders who might be doing 1 or 2 day trading. I think my view is that people should need. So last 2 years, you took a dartboard, you hit that, you put any name on any stock, and you made money. Next 2 years are going to be very, very different. It's not going to be so easy to make money. The easy money making era, in my view, is over.
So, Sandeep, in that context, what is the best strategy, say, for the near term, short to medium term for investors and traders?
Investors need to be, I would say, very careful where they're investing. So they'll obviously be. So India will still be an expanding economy, and as such, when let's say you are, I don't remember exactly what size economy we are. So let's say we are 3 trillion today, and that 3 trillion economy grows at 6%. So that even growing at 6%, you generate an additional economic growth, which is quite substantial. And when that economic growth is generated, there are some companies who get benefited a lot. And so it's important to identify those kind of companies, invest in them, and not be swayed by, I think, the kind of like not be swayed by sort of stories which go around of companies which will make profit 5-10 years down the line, etc. 5-10 years, a lot of things changed. The life cycle of companies itself is coming down these days. So I think that's how people need to be careful of. I think there is a need for investors to keep some amount of cash on the sidelines. So that cash helps you because when there is a sudden fall, sudden correction, some event happens. So then if you have cash, you can deploy that. If you are always fully invested, so there are some people who believe that you should always be fully invested, just spend time in the market, timing doesn't matter. But I have a different perspective where I believe that if you can do some if you like timing is important, because if you say timing doesn't matter, then you are saying valuations don't matter. Then that is the wrong philosophy. Valuations do matter, so you have to buy companies at the right price and then you can spend time in the market. So then you can hold on those companies if they are doing well for the long term. So that has to be the strategy they have to follow. Last 2 years, many people would have bought many stocks on tips, on people's recommendations, and a lot of other ways. And many people, if they open their portfolios, they'll see that they have accumulated 50, 60, 100 stocks. So when such transformational times come like now, then it's a good idea always to look at your portfolio, get rid of the sort of dead weed, trim your portfolio, get it down to, depending on, like, I don't believe in investing in more than 15-20 stocks, but like people who want to be more diversified, not more than maybe 30-35 stocks, and have a more focused approach that way.
So I think so. Just to summarize what Sandeep said, be cautious. So one of the things, I mean, people look at. I mean, if we are entering a cautious environment, and I mean, we are already in a cautious environment. If the last 3-4 months, if they haven't taught you caution, I don't know what will. So what typically happens, right? People ideally should invest in companies with pricing power, strong balance sheets, and which do sort of capital allocation wisely, and pay a lot of dividend, right? So that you are sort of covered. But what would be those spaces? What are some of those stocks that come
Yeah.
to your name if I were to put this in a Venn diagram of these four elements, what are the few names that drop at the center?
See, I think one thing is very clear that Indian financial sector is very strong today. So most of the banks have cleaned up their balance sheets. They have a high capital adequacy ratio. So you look at any of the large banks, let's say ICICI, HDFC, Axis, or so I think these kind of banks, you see, they have very high capital adequacy. Their balance sheets are clean, and they are ready to capture growth as and when it comes. They don't need to raise equity for next 2-3 years, and I believe that's the biggest positive for the Indian economy today. So I think stocks of large banks will do well, and large banks with a strong deposit franchise will always do better in a rising inflationary scenario. Then there are companies who benefit due to a shift of growth. So high inflation leads to suppression of consumer growth. So I think consumer stocks might be underperformers, and as it is, their valuations are high. So I think, and they are very high proportion of lot of investors portfolios. So people who hold very high proportion of those stocks need to relook and maybe reallocate to other sectors, like where there is more of so let's say a company like in the large cap side, L&T is much better placed than any other large consumer stock because valuations are cheaper, growth cycle is strong, and execution pickup will be very good over the next 2-3 years. And then there are companies which benefit out of the entire COVID era led lockdowns ending, and which could include stocks from airlines, luggage, hotels, other hospitality industries, multiplexes, etc. And I believe these will do
Sandeep,
very well because
Sandeep, may I come in here for a moment, just so that we don't lose the train of thought? Hello, Sandeep.
yeah.
I was saying airlines, hotels, multiplexes, etc. They are, I would argue, as much as a reflection of consumer sentiment as they are, about the things that you spoke about, right? I mean, yes, of course, lockdowns are not there anymore, but are people so keen to watch? I mean, I haven't heard from. I mean, there's a Batman movie in the theaters now, but I haven't seen as much craze as typically a Batman movie would cause, right? I know somebody can say Kashmir Files, but of course, that's a different reason. But yeah, do you see, because the consumer sentiment is still negative, right? Or rather, not as great as it should be,
Oh,
given the end of the pandemic.
so I think if you go and look at historical consumer cycles and high inflation cycles, you will see that when inflation becomes high, people look for small pleasures, and to that extent, small pleasures include going out, eating out, going to movies, etc. Because their pockets are got impacted, and they cut down on high ticket items. So we are already seeing that in two-wheeler sales, which are falling drastically, down 25% month on month. We are seeing that in large ticket consumer items, consumer durables, etc. So typically cut downs happen there. And secondly, there is a special event this time where something, so there were sectors which were closed down almost for 2 years, and now people are more confident enjoying that. So maybe there might be a particular circle of people you might know who might not be going out to see movies, but I have a circle of people who are going out to see movies, and I believe that as the content pipeline improves and as people become more confident about that, spending out there will increase, and total spending on many of these industries is a small part of the overall consumption basket of consumers.
Yes,
So
over to you.
Yeah, Sandeep, there's one stock which has been absolutely trending this week. Paytm, we had a huge 23% fall, like even in a truncated week. Um, do you by any chance track this stock? Do you have any take on Paytm?
Yeah, I have a lot of take, and if you follow my Twitter handle, you would have seen what take I have.
We'd like to hear it from you, though.
See, this is a time where companies which have no business model to make money per se are going to suffer, and that is not only going to be this company, but it is going to be a lot of other companies who, like, there are managements who come and say that we don't have any strategy of making profits, we are only looking for growth, etc. That time is over. That zero interest rate era is over. In a year from now, interest rates globally will have moved up substantially from where they are now, and all these people who are used to getting free money, they are not going to get takers at all. And when free flow of money stops in companies which are habitually loss making, then the impact on equity valuations of those companies is even more severe. So I don't know what you should do at current price of Paytm, because I've been advising people to exit right from, I don't know what the top was, maybe 2000 or something. So when stocks fall so much, just technically they might just bounce 20-30%. So I don't want to say to people that you should just dump all Paytm you have today and 3 days, 4 days later it jumps up 20-30%. But directionally, I'll say that owning such companies is not going to make you money. And at what price you want to exit, that call you have to take.
Sandeep, do you have any favorites from this space? I mean, I've come across many conversations on other business news channels where amongst these names like Zomato, Paytm, Policy Bazaar, Nykaa is one where most of the people are, still bullish. Do you have any view on Nykaa or any of the other names? Do any of them appear attractive to you?
Yeah, so among all the stocks which are there, recently listed, kind of, so Nykaa and Zomato are two stocks which I would look to buy at some price. Now, at what price I would like to buy is still substantially lower from their current market prices, because these companies still have a business model. They will eventually make decent money in my view. Maybe it's few years down the line. And there is a focused approach of operating. And you look at Zomato, the industry in which it operates, it's more or less become a duopoly now. And Nykaa has a good business model, but Nykaa's valuations are still very, very high. I believe that they need to fall substantially from current levels for it to come into buy zone. And Zomato, I would think that around 60 I would be interested.
Sriram, do you have any question?
You have moved on from Fed. I still have questions around Fed.
Yeah.
Sandeep, so my point is that on that count, there are two things that are going to happen. One is it's not new. We've all known it and we've spoken about it. We've done stories, which is that the dollar is going to get stronger. My question is, does yesterday's commentary from Fed, um, does that change how fast you expect the dollar to strengthen, or even if it's not your own analysis, if there is any credible commentary that you would like to highlight? And of course, one question that I've been trying to ask market commentators is, what this will do is it will make the repayments more expensive for companies that have borrowed heavily from foreign banks in foreign currencies. So companies with dollar debt, how badly Is it going to hurt them? And are there any names that you would advise where the dollar debt is too high?
No, firstly, I think we are not in that kind of scenario wherein like 2004 to 7, where companies borrowed heavily from overseas because domestic interest rates were so high, and rupee was continuously appreciating, so everyone thought that it will never depreciate. So we are not in that kind of cycle. I don't see many companies who are heavily borrowed overseas, except for one or two, but those also have overseas operations to back them. So I
That
don't
that
see that.
that except for list is what I'm interested in.
Sorry.
That list of except for companies, that's what I'm asking about.
No, but I think those companies have foreign operations to back that. So I don't see that as a big concern. Secondly, whether dollar is going to appreciate continuously is a debatable question. Given the fact that post this entire Russia issue, there are some countries looking to start trading in yuan, etc., and the dollar index is a complex interplay of several currencies where it's very tough to say that which way it will move. But I think the bond yields are going to move up for sure, and to that extent, interest rates are going to harden, and that is more of a certainty than dollar per se tightening, like strengthening.
Okay. So my question was that has Fed commentary changed your outlook on dollar? I think your answer is no, right?
No, that doesn't. It doesn't actually.
Cool. Yeah, sure. What to you?
So we've got Sushil as well as the speaker. Sushil, what do you make of the market move? The Nifty is up 7 out of the last 8 days. We're above key levels. 200-day moving average has been reclaimed. What do you make on the technical side? What are the charts telling you?
It's looking strong. I don't think 200-day moving average counts much. But yeah, it's a sentiment for the crowd that it's crossed. But except that, don't give too much weightage to 200-day moving average. But I think this up move is still very strong. So let's see what happens at 17,800. And then we'll figure out whether this is indeed the move that's going to take us into all-time highs. Chances are it is that one. But given how things have been worldwide, let's eat the elephant with a fork and knife, and I'm playing for 17,800 right now. And then maybe we'll expand to 18,200, 18,600 and more. With or without a 1,000-point correction from 17,800, if you hold a revolver to my forehead and say, first 20,000 or first 15,000, then the answer is 20,000. But if you don't hold a revolver, I like to cross the bridge when it comes.
All right. Sandeep, before you leave, I think one of our listeners has a question. So Praveen, you can quickly unmute yourself and ask your question. Okay, I think he's dropped off. But Sandeep, thank you so much for doing this. We know that it's Holi celebration, so this is the time when usually people are busy with their family. Thank you so much for taking the time out and joining us for this really interesting and insightful Twitter Spaces session.
Sure. Thanks. Bye. Best of luck.
Thank you, Sandeep. Thank you. Sushil, did you have any thoughts on some of the questions that I had raised? And I'm sure. Would you like me to repeat
Sorry, I
it?
missed you. Any thoughts on?
The questions that I was asking about, dollar debt companies with dollar debt, or basically, how do we? So there is some commentary coming in from the US, of, the critics of the current Fed chairman or the current administration, who say that chasing this aggressive chase to contain inflation, and will lead to a spiral in wages. Basically, inflation, wages trying to catch up with inflation, and that could trigger an inflation, a recession in US. because that's what has happened every time these two things interplayed. And do you what and that's just one side of the argument. So would you give it any credence, and what are your thoughts on this, on how it could impact, because this recession caused by this particular factor would be different from a global financial crisis or a oil shock?
See, I'll tell you, no special theory or no special piece of knowledge can supersede common sense. And coming from the school of common sense after dismissing everything else, I basically want to ask, if recession is bad and inflation is also bad, then what does this world want? So this world perhaps wants, it definitely doesn't want recession. That's a horrifying word. So what this world needs is a sensible level of, nobody wants to drink a boiling hot tea. We all want to have some hot tea. And nobody, of course, likes a tepid or a cold tea. So warmth is what is desirable in your cup of tea as well as in the economy. And you don't want it to boil up. So this sudden sense of getting boiled up that came on the horizon, on one hand, there is this steroidal, insane liquidity infusion that happened because the global economy had a heart attack. So on a heart attack, you have to apply the defibrillator. You apply electrical shocks to the chest of a man and save him from dying. But once that person has started reviving, you don't keep on demeaning him or kind of diluting his stature as a living entity, or even, weaken that person by keeping on giving those electrical shocks. Pagal ho jayega fir to. So in extreme situation, giving electrical shocks was necessary. Now, if anybody gets onto the crutches, so either, that person is bored or has not been comprehensive in thought, but just using common sense, मतलब आपको जिंदगी भर बिजली के झटके ही खाने, तो आपको आदत पड़ गई है, झटके ही खाते रहना is not normal. So from the ICU, when the world is returning back, we also have had massive disruptions, supply side shocks. And a third source of inflation that can be, there are potentially three sources of inflation. More liquidity than is constructive any longer. Any logistics or supply side disruptions that first happened very vividly due to Corona, and now this war is causing the mother of all disruptions. And the third one is the healthy inflation, that there is, growing demand. Which business does not want a growing demand? Its only thing is that when there's too much liquidity, profligate investing is happening, profligate demand creation is happening, or profligate consumption is happening. So this profligate liquidity, systemic liquidity, it's like this. If you have vitamin D, it makes you, your testosterone goes up, your estrogen goes up, your bones become stronger, and you are in a pepped up mood. But if you get vitamin D toxicity, you get angry. I suffered from it recently. And I was happy my testosterone reading is going up. My doctor screamed at me, "Bastard, your vitamin D has gone up beyond 90. So same thing. When liquidity is shot up beyond a point, okay, it's going to work like causing an angry man. It's no longer pepping up your mood with vitamin D. The other side of inflation, which is supply side disruptions, they seldom become a permanent affair. And most commodities that were in backwardation means the current month delivery prices of commodities are significantly higher than next month, which is significantly higher than 2 months down the line. So it's a backwardation in commodities means there's a short-term shortage of deliverance that could be due to shipping, that could be due to mining, that could be due to not being able to bring stuff down to the ports. So that's what is transitory. And the third one is, if there's too much consumption happening, because people don't have enough incentive to invest. So now to go and say every time it's different, of course this world is similar to what it was yesterday, and today is never the same. There is going to be a difference of nuances, but the basic ideas of common sense will always prevail. So for the last 50 years, every rate hike cycle, equity markets produced unbelievably positive returns, And rightfully so. In a healthy economy, if we were given doles all around during Corona, and people were tolerant, ki chalo Modi is distributing this ration pani, not even opposition could come and say, it's going to make him stronger in elections. नहीं तो लोग मर जाएंगे. But अगर आपको जीवन भर खैरात ही चाहिए, तो you are emotionally, mentally, spiritually, financially, stamina-wise bankrupt. Okay? So withdrawal of stimuluses is necessary. It's only for a very critical situation that steroids are given. Steroids will never become your food supplements. So now comes the point, if they are not withdrawn, what would happen? The same thing that would happen if you don't withdraw vitamin D or do not withdraw steroids, your body will go haywire. So your consumption patterns can run that risk of becoming haywire. So withdrawal of liquidity is one thing. Fed is not beginning to withdraw liquidity. Fed is going to stop pumping more steroid, and it is going to decrease the increments of money supply. And if money were free, you would have profligate investing in Zomatos of the universe and Paytms. So going forward, as a responsible attitude towards the cost of money arises over the next 3-4 years of incremental cycle, this P game, every kid on the block looking for, what was that, Shark Tank. So the Shark Tanks will, become smaller. That's what. And there will be responsible investing. Now, risk-free rate of returns are going up across the board. And there was a 7-8 year down cycle. It's not just that Corona mein hua. Corona only postponed that reversal. And because of that, it looks like ki ek saath jor se ho raha hai. But any big reversal will appear nasty. So Indian interest rates will also go up. Everywhere it will go up. But that does not mean at all that we should, abandon the sense of bull market. The biggest and the best bull markets happen during rising rates. So there will be differentiation. A Hindustan lever that appeared very, very overpriced 1.5 years ago. And now in this return of inflation, and during this period, it has had some earnings growth. So the valuation has come down from that 50 P ratio to somewhere at 40. And maybe, a Hindustan lever goes to 45 and the earnings of Hindustan lever go through the roof. And then, the P ratio on Hindustan lever comes down to 35 and the stock has still doubled. So that kind of earnings reallocation, companies that are going to be able to pass through inflation because of loyalty to brands, because of loyalty to necessities, because of loyalty to affinity. So investing flavor will change from gambling into companies that do not even promise profits after 5 years. Investors will chase earnings headlines. So if IT stocks are going through the roof again still, for all the pessimism on NASDAQ, actually from my chart reading, and maybe, based on the market view I take, I'm looking at that angle of the economic theory that suits it. That's how it has to be rationalized. Everybody intuitively does that only. Sab pehle market ka feel nikalte and then what will work it out. Nobody's a pure thinker. Nobody can afford to be a pure thinker. So I think NASDAQ is also going to a new high led by Apple. I tweeted that 2 days ago. And if a dog of a stock, Facebook, we tweeted 2 days ago that, it's the best bet. It's going to zoom up like 40% from here. And yesterday's move on Facebook. So that kind of, the time to time, this fear that is coming in, it's lightening the bull brigade, Tom, Dick, Harry, सबको रातों रात पैसा double करना था 4 महीने में सबको लंपट थप्पड़ मार दिया market ने. That's all has happened. But to say that interest rates are rising, so economy will go down and markets will go down, so then markets will never come up. Because if economy goes up, everything should become costly and money should also become costly. Irresponsible use of money will go away. And amongst the currencies, see, Euro and GBP are at such a rock bottom, those charts cannot be driven lower. So if this strength in dollar index has been sort of persisting, I was keeping on looking at the G7 currencies last some days. The almost inert currency, which is the Swiss franc, supposedly, theoretically, the strongest currency in the world, because from every politician to mafia to every clandestine person, nobody wants Switzerland to be hurted. And in the last 500 years, it's not participated in any war, not a bullet has been fired. It's the strongest and safest currency. The Swiss franc, from an inert sideways 2-year, 3-year consolidation, has kind of, the dollar's broken out upwards against that. So maybe the euro will go up, the GBP will go up, and the dollar continues to go up with the Swiss franc. So there are many adjustments central bankers have in their hat of magic. But say if India interest rates continue to go up, US also go up, and if I've taken a public bold call that this all-time low on the rupee is to be faded and we are headed back to 72, how will that happen? So say the ratio of interest rates between India and USA, the ratio of interest rates between India and USA will become smaller. Say from a 6% interest rate in India for the 10-year and we had a 1% in the US, it's come to 1.75% in India, goes from 6% to 6.25. So the ratio compression between the two rates will justify that the rupee appreciates against the dollar. And lastly, inflation in some parts of the world has gone very high. In some parts of the world, it is lukewarm. So as happened in any electrical circuit, the potential difference for global trade to flourish has been set up. Economies with a noticeably high inflation, an eyebrow level inflation, they will be natural exporters of inflation, and economies that are kind of tepid inflation. So if RBI at the last rate policy did not do any hike, and people said, "Kya kar raha hai banga?" It's all global adjustment. India will be an importer of inflation. China will be an importer of inflation. So we saw a world that went into a state of total shock in 2020 March. Until March 2021, we were in a denial. From 2021, we labeled it as a Robin Hood investment rally, and then markets became overvalued. That's, to my mind, over a 5-year kind of a bull cycle. We have lived 2 years, the first phase, and then the correction of the second phase has come. But I think here onwards, the pure stock picker, the pure investor, it is going to be a pure investor's market, investing on the merit of earnings. The fundamental investing is going to return back. The first phase was the liquidity investing. The fundamental investing is going to return back. It has never happened in history and will never happen in history again in the future, that if central banks start reducing liquidity, pump markets will go down. It has never happened, and it can never happen, because if that were to happen, this world will finish. Then central bankers will keep on increasing. Which politician wants criticism? Which politician wants dropping stock markets? Which politician wants wealth effect to vanish? Nobody wants it. So that's a parochial argument, and I'm in this atmosphere of deep disbelief, looking at lots of stocks and lots of charts that look like will produce very handsome returns over a time. It's of course not going to be like as easy as just go and randomly buy any stocks and they will make money. The men and boys have started getting separated in this last 5-6 months of correction, and going forward, the separation between men and smarter men is going to happen. The boys are almost half killed. So with that as a preamble, I would say I'm not at all worried. And this is business as usual. That's how the world has transacted itself in the last 100 years. वो 1929 का parallel निकाल लो. As of now, वैसा scene नहीं लगता है.
I think if the advice, based on both Sushil and Sandeep's advice, Yash, basically, if the advice is to follow good companies with strong earning potential and a strong fundamental business case, I think no amount of economic theory will change that, right? But Sushil, just to sort of, I am going back to your initial comment on the warm tea, right? Not boiling hot and not stinging hot, not ice cold. But warm tea. I think the argument has now moved on from whether or not we need interest rate hikes to now the critics of Fed are saying that you've been too late. And that is detrimental to quote unquote price stability, a very Milton Friedman kind of an argument, which is basically to say that, things are going to be unstable for a bit because you've been late to react. But really, I know we are out of time here, and, I guess this coffee table intellectualization of things can wait, and people can go on with their lives. Yash, so back to you. We will wait for the proof of the pudding, I guess.
Absolutely. And guys, we have this spaces recorded. So in case if you missed any of the answers from Sandeep in the beginning, even Sushil, then we highly recommend that you go back and listen to the entire space. It'll be the first tweet pinned right at the top. And while you're doing that, go ahead and follow us on all the other social media platforms as well. Sushil, it's lovely speaking to you. We hope that one day you are on StockTwits as well, where we can have a lot of our followers and users getting to know about you and your thoughts on markets and all things finance. Yep. So with that, we'll wrap it. Happy Holi, guys.
Happy
Really
Holi to
looking
everyone.
looking forward to the long weekend. Stay safe and invest safe and enjoy
Happy
the
Holi
holiday.
and play Holi also safely. I mean,
Yeah.
I know pandemic is over and everybody is feeling very chill. I don't think we are there yet. I know it's a fun festival, blah blah blah, but uh, you know, follow whatever protocol you can without breaking the spirit of the festival.
Absolutely. All right, guys.
Thank you.
See
Thank
you
you so
next
much,
week,
guys.
same time, same place.